why do I have to keep doing small multifamily? Why do I have to keep doing 8-unit and 10-unit buildings? Why not take down a huge property, right? It may be a little longer, maybe a little bit more challenging, but ultimately it's not that hard.
Welcome to the Multifamily Wealth Podcast. I'm your host, Axel Ragnarsson, and on this show, I dissect how seasoned multifamily investors started, built, and scaled their businesses. What's going on, everybody? Welcome back to another episode here on the Multifamily Wealth Podcast. I have a great episode this week with Ryan Corcoran, who is a New England-based investor. Technically, he lives in Rhode Island, but invests throughout New England. He also invests throughout the Southeast. He's got some deals in Georgia and Florida as well. But he is very similar to me in that his business is built off of direct-to-seller marketing and just does tons and tons of deals off market, whether it's small multifamily, mid-sized multifamily, very large multifamily. He shares a story in this episode about how he found a 600 plus unit portfolio through direct mail. I mean, deals of that size can be found through direct to seller marketing, and you're going to want to stick around and hear how he did that. But, you know, he does 40, 50 deals a year, flips some, holds some. And this is just a great conversation between two operators, you know, two folks that are really in the trenches, you know, talking about myself and him. And we talk about how real estate investors should think about selling. And, you know, both of us are big proponents of selling, especially as you're growing your business and especially when you're early in your business, because you need that money coming back in your business. We talk about how we think about selling, you know, how we would have, you know, done things differently if we both started, you know, growing our portfolio over again, and how we would have approached those early deals a little bit differently. And Ryan gets into the weeds from a direct to seller standpoint as well and tells us all about what he's doing. You know, from just a very tactical standpoint, basically talks about exactly what he's doing on the direct mail side and how he uses direct mail to find so many off-market opportunities. So this is a very tactical episode. It's very casual too. It's Ryan, someone I've known for a while. We've worked together in the business for a couple of years now. So highly recommend you give this one a listen and stick around all the way to the end because there's gold throughout. And if you haven't already, please leave the podcast a rating and review as it helps the episode and the show get noticed by more folks. And again, as always, thank you for listening to the Multifamily Wealth Podcast, and I'll catch you guys next time. What's going on, everybody? Welcome back to another episode here on the Multifamily Wealth Podcast. Joining me this week is Ryan Corcoran, who is a repeat guest, actually. And I don't know the last episode number off the top of my head, but I'll include it in the show notes. But he's somebody that I've gotten to know over the last year and change, a couple of years. It's been something in that range. Done a couple deals together, and he's a beast at finding deals off market, which is what we talked about on the last episode, and we'll probably touch on that again in this episode. But Ryan, why don't you give everybody a refresh on your background, how you get into real estate, and you know what you're up to now?
Yeah. First of all, I apologize for the lighting on here. My background isn't great, but
no big deal.
And I had so much fun on the first one. I had to come back for another one. No, I appreciate you having me on. So background, I bought my first property when I was 21. I bought a duplex, and it was either go rent somewhere or buy something to live in. So I ended up going the route of buying something, although I didn't actually live in it. So I rented out both units, stayed living at my the house I grew up in. Fixed it up, sold it, made what I was going to make in 1 year as a PA after I got my master's degree from selling that property. And I was like, okay, like something's, I got to explore this. So I did it again and again and again. And then after, you know, a couple of flips of small multis, I ended up doing, you know, larger buy and holds. So, you know, a 5-unit, then a 6-unit, then a 9-unit. And so now, you know, I've done over 300 units. I've got about 250 that we have currently in the portfolio. We do 15 flips a year now. I mean, last year I did like 2 flips. 2 years ago I did like 2 flips. This past year we did 15. This year we'll probably end up doing 20. And now we've got a wholesaling arm where we'll probably wholesale 10 to 15 homes as well. And then we've got a couple development projects going on as well. So I'm all over the place from the last time we spoke. But yeah, no, everything's going great despite, you know, market swings, you know, some tactics adjusted, but I'm sure we'll get into that. So,
yeah, no, absolutely. And, you know, I think you and I are similar in that we're kind of just deal junkies, right? And just like doing deals, whether it's, you know, granted, I don't do a lot on the flip side, but we do a lot of like smaller multifamily projects, which is, technically outside of what we're trying to do from like a core criteria standpoint. We'd like to do bigger deals. We would like to only do bigger deals, but it's hard to not get distracted with the occasional smaller project, smaller multifamily. And when you're going direct to seller at scale, like what you're doing, obviously you're coming across a lot of these opportunities. So, why don't you, because, I do want to get into maybe how your business is slightly changing now as it relates to some of the projects that you're doing at the moment, especially as it compares to the last time we spoke. But before we get there, maybe talk about how you think about what you're doing in real estate, and in terms of what types of projects are you looking for? Do you have a core criteria, and how are you actually getting out there and sourcing deals right now? Because that's definitely your special sauce.
Yeah, so to be honest with you, the deal finding has never changed. It's always been direct to seller. I bought one property off the MLS, and it was the first one. And then after that, I realized I couldn't make anything work. And so I naturally just started, sending direct mail. Doing direct email, cold calling, and so, over the last 6 or 7 years, that's really all I've done. It's been direct to seller, helping people out of situations that you can't imagine that the phone calls that you actually have when I'm sure but the idea here is that you're going direct to seller to try to find a deal that you're going to buy. But 99% of the time, that person, you're trying to solve their issue. And if you get to solve their issue, you end up with a really good property, usually, or a deal, right? Whether you flip that, hold it, wholesale it, it's totally dependent on the property itself. And that's really what changed over the last, year and a half for me. But initially it was buy and hold everything. And then I realized, okay, like making $750 a month or $1,500 a month or even $2,500 a month from a rental, it's fantastic. Don't get me wrong. But like, how do I take these leads and make 50 or 100 or 200,000 a month? Like how can I do that with all these other leads? And so I started to realize, after I built up a big portfolio of buy and holds, I was like, well, instead of letting this 2-family go, maybe I can wholesale it to somebody, or maybe I can flip it myself. And so, we really started to try to optimize all the leads that were coming in. And fortunately, this happened right when, COVID was going on, market went kind of out of control. But now the interest rates are going higher. It's even more so for me, how do I utilize all these deals? Because, the BRRRR model right now is to me, it's a little challenging, right? That's really what I based my model off of the first couple of years doing real estate. I buy something at really low, really below value, off market, direct to seller, go in, infuse a bunch of money into it, raising capital to it, increase the rents. Let's call it a 10-unit building. I've now increased the rents by, let's call it, I don't know, 40 grand a year. And now it's worth an extra $350,000. I would refinance that and pull back out the money that I raised for the down payment, pay that person off, and now I'd have this property. The problem now is that I can go buy that same property, and now the cap rate, instead of being a 6, is, let's call it a 7, which, if you know anything about commercial real estate and cap rates, that could be 20 grand or 250,000 or $2 million in value swing right there, just by going up 1% in a cap rate. And so it's making BRRRR a little bit more challenging right now. And so my business model kind of turned to, all right, how do I utilize all these other leads and just almost have another business running that's generating cash, right? A bunch of cash coming in that I can still do these BRRRRs, but at the same time generate essentially a whole nother business on the side of it. So it's worked out really well.
So it seems like maybe the shift has been, as interest rates have gone up, and you're kind of pointing out the challenge with that not being the mortgage payment amount or the debt service amount, but being the corresponding effect that it's had on cap rates, and then therefore the valuations of the marketplace. And you're buying a deal, and throughout the process of stabilizing it, adding the value, renovating units, pushing rents, et cetera, the business plan, by the time you get to the point where you're going to refi, maybe the market has softened up a bit, and therefore your appraised value is not as high as you'd like, or not high enough to allow you to pull all that cash out. Am I summarizing that correctly? 100%.
And I'm just going to use a deal just to kind of give you the reason why I did this. I bought a fairly large apartment building that was 1.592 million when I buy it. So when I bought it, 1.592, I used short-term debt to buy it when rates were freaking 3%. And so I had it ready to roll at refinance after I did all the work, and it appraised at 2.2. And I was like, beautiful, did another one, check it off the list. The bank backed out of a 4.9% interest rate that they had locked me in the day before their commitment. Well, what had happened during that time is rates went from 4.5, 5 to 6.5. And so all of a sudden they backed out at 4.9 for me. I was going to be able to pull out 100 grand. It was going to be fantastic. Instead, now I have to bring $200,000 to the table just to close this refinance. And so, I had a couple projects going on at this time, and I'm like, I don't think that I want to do this, right? Like, I don't know how am I going to how can I do it? Sure, I can swing it, but do I actually want to do that? Does it make sense? So I ended up selling that property, and since then I'm kind of like, man, like if I can't execute these burrs the way I've been doing it, my business model has to change, right? Like I can't do these projects to then, instead of refinance and pull out the money that I put in, I can't be infusing more money, right? Like now we just have diminishing returns. And so that's really when I started to, go into, okay, well, if I have this thing really, really steep undervalue, I'm going to wholesale it for 15 grand or 20 grand or 100 grand, right? I'm going to go flip this and make 20 or 30 grand. I'm going to lock this, this deal up because I see other potential in, hey, there's an extra lot that comes with it. I can subdivide that and I can build this lot. I would have never thought of this stuff before because I was so laser focused. And I'm not saying that it's good to, go off and do a bunch of things at once. But just being able to pivot when you have a market adjustment is crucial.
Mm-hmm. No, absolutely. And that's, it's interesting. So it just sounds like in general, maybe you've been a little bit more transactional and being open to being more transactional, right? Maybe we buy it and then instead of, me holding this and maybe having to bring a little bit of money to closing or refinancing into a loan that's got a higher interest rate and therefore, I'm not, maybe I'm not bringing capital to closing and I still get out of the original loan. I'm not making that much from a free cash flow standpoint. And maybe it just makes sense to flip this one, exactly. Or to be more transactional. And that's, I think it's an interesting approach because, this is the Multifamily Wealth Podcast, right? People in multifamily like to hold everything, right? There's an opinion that holding is best, that when you sell, you give up all of this future earning potential, that, the best real estate investors buy and hold forever. And there's obviously all kinds of truth to that. And I think both of us still want to hold as much real estate as we can because we want to do that. We want to grow a portfolio, want to continue growing a portfolio. But there are times where you do have to sell where it does make sense to sell. And making that pivot is interesting because a lot of people are so allergic to selling, right? They're just so afraid to do that because they want to hold everything. They want to keep growing.
Dude, I'm so happy you bring this up because all you ever hear on podcasts is, buy it and hold it for 30 years, buy it and hold it for 30 years, buy it and get the cash flow every month for the rest of your life. You don't ever have to sell it. It's fantastic. I quite literally don't understand how you can do real estate full time and be a multifamily investor and not sell properties. How do you make enough money? Even like, think about this, like even like $2,000 a month from one property. If the roof goes, your year's cash flow is completely freaking gone. So that property, let's just wipe that out. Right. And so I just don't see how it's sustainable for you to hold every single property you buy forever. It just doesn't, it's not realistic. I think the best way to do this is as you start to grow, look at how much equity you have in your properties and look at how much of a return you're getting. They call it return on equity, right? If you've got a lot of equity in there, but it's not making that much money, maybe it's best to sell it, take that capital and either, stash half of it as a safety net or buy another property that will produce, more capital. But I'm so happy you bring up the fact that like everyone's allergic to selling. It's like you have to sell sometimes in order to keep the business going.
And I think that the dichotomy in thinking about that decision, right? The two camps, if I'm going to very, very, generally put people into two different buckets, it's the people that are investing in real estate as either A, a side hustle, or B, like they are the definition of an investor, right? They have some other income source. They buy a property or a couple of properties a year. And, that cash flow is supporting their retirement. Maybe it's, sending them on a couple of vacations a year, but that's not their income source. They're still working their job or running their business outside of real estate, what have you. And then you have the people that are in our boat who are trying to make a business out of the real estate, or trying to create a business within the real estate industry. And there's a whole different set of challenges there because you have to send money back into the business. And this is what I tell a lot of people. And it's funny, I was speaking at a meetup last week up in New Hampshire. And, I was talking about the topic of selling came up and I was like, we sold almost half of our portfolio last year. And it has nothing to do with like, we think the market's going to crash. We think it's going to tank. We want to get out before it turns because that's not the reason we did it. We did it because we sold a bunch of small properties so that we can continue putting money into large properties, but also being able to hire the virtual assistants, spend the money on the marketing, spend the money on somebody to help make the content a little bit better so we can attract more investors. And if you're going to be in the business of creating a real estate business, not just the investor that throws some money into real estate, does a couple deals a year, but it's not your primary income source. You don't need those big capital events to fuel your life or your business. You do have to let some properties go, right? And the simple exercise, as you mentioned, is just how much equity do you have and what are you making on it? Even if you sell and you don't even bring that money back into your world, in terms of you pay your capital gains tax and you throw the money in your checking account, even if you do a 1031, even if that the property you're exchanging into produces more free cash flow, you should constantly be looking for opportunities to do that, because yes, you maybe are making nominally less, right, when you close because you're 1031ing a stabilized building into a project, but you have a roadmap to turning that equity into more cash flow, right? So you should constantly be thinking about that. And there's different ways to explain it, but it is one of the biggest challenges of being early in this game. And it's you're in the business of raising money too. And you got to charge some fees on the deals that you raise money for. You don't have to charge crazy fees, but you got to charge some, because you got to make that cash registering at different points throughout the year. And then you got to sell every once in a while.
You also need to live your life, right? Like, it's so, I don't know, man, the first couple of years when I was doing this, I was under the impression that I was going to buy everything and hold it, and just the cash flow would be enough for me to survive. And it's just, it's very unrealistic. I hate to burst the bubble, but it really is. It's unrealistic to think that that's going to work. So I'll leave it at that for now.
And a couple of asterisks, because I want to ask you about one, and I'm kind of interrupting you here, but I think there's a topic that's relevant on this. So, that's unless you're doing some crazy management intensive strategy, like short-term rentals or medium-term rentals, or you're doing something where people think that, oh yeah, we get all this cash flow because we're doing that. Yeah, you are trading your time for that, or you're paying someone to trade their time and you're paying a higher management fee. But if you're earlier, maybe you can get by without selling because you're not doing, long-term leases and you're creating more cash flow, right? That's one example of this. And I know that somebody's listening who's going to be like, well, I do this. And okay, that's fine. But you're trading your time for that, right? And you have to make sure that you understand that that's the trade you're making. But I think that another piece of this that's specifically challenging for you and I, given where we live, right? We live in New England. Everything here is old. All of the properties are ancient. And there is just such an ongoing demand for money in terms of just it being spent on CapEx, whether it's the old plumbing or the old electrical or the old roof or the support beams in the basement, which are 50 years old, are starting to give away, and you got to throw some money down there. And then you got an old boiler that's, forced how it's just always something, right? So I think especially if you're in a market where you're buying old properties, or you're buying C-class properties and you're constantly dealing with turnover, this is especially true for you. You should definitely be embracing selling, because those deals just don't cash flow as much. The early 1900s stuff, the C-class stuff, comparatively to if you're buying, 1990s build B-class on a very stable market, something like that. That's just a much more predictable type of real estate investing, and I think that's for me, that's just an asterisk for everybody out there. And I know it's something that you and I could probably talk about for a while, the challenges of buying that type of real estate.
Yeah. No, absolutely. That's a great point. Another thing I'd like to bring up on this topic, and we can move on, is that, I think, if I were to go back and, because I spoke at a meetup a couple weeks ago near Boston, and somebody asked me hey, what would you do differently if you were to start over? And immediately what I thought was, what, instead of buying these rentals that were going to be long term, I would try to focus on, maybe it is flipping, right? Maybe it's, okay, I'm going to get really good at finding deals, and I'm going to flip houses, or I'm going to wholesale houses. I'm going to figure out how to make a drastic amount of money really quickly, instead of buying rentals first. And the reason I say this, and I'm going to get a lot of slack for this, is that the moment that you don't have to worry about money when you're buying a property, you have a huge weight lifted off your shoulders. So you can then go make really educated and execute on decisions that are really good for the business, instead of just, I don't know, I need to do this because I don't have any money. I'm struggling. I got to do this myself, right? The moment you can say, all right, I'm going to go wholesale this, I'm going to make $20,000 this month. Well, how many properties do you need to buy to make $20,000 a month for rentals? But quite a bit, right? Quite a bit. And so I don't know. I would probably change my mindset to, let me learn how to wholesale and flip. And it's really the same concept. You're going out, you're going direct to seller, and you're finding really freaking good deals. Instead of buying everyone, generate some income from that, and then you can start buying properties. Whether you raise money or not, now you have a nest egg that you can sit back on. I did not have that. I had no money for the first couple of years, and I was bootstrapping everything. And so I don't know. It's something to think about.
100%. Yeah. And I think, this really should hit the people that either have, a low paying job that are trying to get out of it, or just, not a significant income source. Cause similar to you, I got into this, late college, right after college, right? That's when I really started, getting going. And this is the this advice is just opposite of what most people give on podcasts, where people are like, oh, I should have never sold anything. I'm like, I should have sold more stuff. And the big asterisk around that is because it was specific to my situation. It sounds like that's specific to yours too, where, I bought like a 3-unit, then the next year I bought a couple, more 3 units in a duplex, and the next one another. I could have just bought more real estate more quickly if after I bought the property, did the value add, I sold it. Because when you think about the life cycle of a deal, at least in the value add multifamily world, which is what most of the people listening to this are in, you create the majority of the returns from an investor standpoint. You create most of the value, you make most of your money, right? If we're going to boil it down to that language. And, the first 2 steps, buying at the right price, because that's the most impactful financial decision you make around an investment, is the price you buy it at. And then as you do your value add, you do your construction, you do your, your renos, you raise the rents, whatever. Those are the 2 most impactful processes. And that's where you make the vast majority of your money. And then after that, you're basically just exposing yourself to what the real estate market does. If the real estate market helps you, great, you can make more money. If it doesn't help you, well, you're going to lose some money. If you're not a great operator and you don't operate really well, you're exposing yourself to the rest of the marketplace. And yeah, selling isn't tax advantaged, right? But maybe you can do a 1031. Maybe you can, quickly refi and repurpose. But fundamentally speaking, boiling down, the most important activities are, buying the deal, right, and paying the right price, and then doing a good job in that first, 6, 9, 12 months of creating the value. Those are the 2 most important steps. And once you create that value, there's not a lot left for you to do. You can't really, your effort's not really making you that much more money. So that's where you should consider maybe selling. So that's a bit of a soapbox thing for me. I probably would have sold more stuff, but anyways, we can touch on something else. But it's a funny way to think about the business for sure. Just a different lens.
Yeah. So that was gold.
Yeah, so let's talk about your direct mail strategy. I want to dive into that a little bit more because that is, I know you're doing other things to find deals, cold calling, doing some cold emailing, and maybe we could talk about that as it relates to your direct mail strategy. But I do know that, at least from afar, right, from my perspective of your business, you really do lean on direct mail to find deals, and direct mail has found you a lot of deals. Can you talk about how you think about sending direct mail? Maybe what your process looks like, your list looks like, some of the high level kind of key bullet points in terms of how you approach that side of the business.
Yeah, it has really evolved since I started. At first it was handwriting them myself with a printer and doing everything myself. And then it evolved to, all right, I'm going to hire, some, local guy here to do it all for me. And then it was, okay, I'm going to scale this. How do I do that? It's been a huge learning curve. But nonetheless, it's worked throughout the last 6 or 7 years. And I don't really have like hey, this is exactly how you should do it, because the biggest thing with direct to seller marketing, whether it could be cold calling, email, PP, anything, any direct to seller marketing, it's all timing. So I can send a letter 15 times to somebody and they'll never reply. But then the 16th time, they might be ready to sell the property. I'm not going to know that unless I consistently do what I'm doing. And so, I run into a lot of guys who, I did direct mail for a couple months, I sent out, 500 letters and didn't get any callbacks. Well, obviously you didn't get callbacks. Like if you got a letter to sell your property today, would you do it? No, probably not. But, if you, God forbid, you have a loved one pass away and you need capital or something, and you get a letter the next day, you're going to think about calling them back then? Maybe, right? And so that's really the idea behind it. And so, we'll send, we started off sending a couple hundred. Now it's, and then a couple thousand. Now we're close to, 8 to 10,000 letters a month. We'll do white letters. We'll do handwritten letters. We'll do professional letters. Recently we've gone into postcards because, like I said, I pivoted a little bit. So now I'm sending, blasting postcards out to, vacant homes, absentee, homes, stuff like that. But since we're focusing on multifamily, what has been super successful for multifamily is you want to put yourself in the shoes of the person that's receiving the letter. And so, most of the time, if you're trying to buy a 10-unit property, it's not just some, random guy who owns it, right? It's somebody who knows what they're doing. They bought a multifamily property that's 10 units, probably cost them close to $1 million. they're likely a skilled investor. And so the letter that you want to present to them should be very, in my opinion, should be professional, right? Like, I know what I'm doing here. My name is Ryan. I own other properties. I'm looking to purchase properties in this area. If you're interested, give me a call back, right? Versus if you're trying to sell it to a distressed homeowner, it's, hey, we buy a bunch of properties here, cash, we close fast, no hassle, no agent fee, nothing like that, right? See the difference there? And so I know it's a lot to grasp, but and there's tons of courses you can take on direct mail, but it has been huge, man. Like, we'd almost hit 40 deals last year from direct mail. I mean, it is crazy. So it works, and a lot of people knock it. But the other thing I like to bring up is that, not many people use mail anymore. So, but I still go out to my mailbox, right? And so when there's only 3 things in the mailbox and one of them is a letter and the other 2 are junk, I'm likely going to open up a letter that looks like it's directed right to me. And the less mail that's in there, the higher the chance I have of opening a piece of mail. And so that's kind of how I've looked at it. We've got it systemized. We have a couple VAs. They'll pull the list, scrub the list. They'll do the whole thing now. So I've kind of backed out of that. But it took a while to get to that point.
Mm-hmm. No, for sure. I mean, 8 to 10,000 mailers. I mean, that's considerable, right? How do you filter? Do you have like you mentioned you're sending to maybe a few different data lists, right? And you have a few different criterias, but let's say you're entering a market, I don't know, near you in Rhode Island or up in Mass or wherever it might be, whatever the market is. What type of list are you pulling? Where do you pull it from? How do you filter it? And how often do you mail to it?
Okay. So the last question, every 3 months I mail a list. So
got it.
So, well, usually it works out that way. Sometimes you're going to get repeat leads on certain lists. So and a lot of times if you mail somebody too much, they're going to be like, take me off your effing list. You get those calls all the time, right? Yeah. I've used ListSource, I've used PropStream, CoStar, Reonomy. I've used almost every single one of them. And I don't have one that I like better than the other. They're all pretty good. They're all like, their accuracy is like 99 point something % across the board for pretty much all of them. The difference is if you're looking for large properties, PropStream and ListSource probably isn't your engine that you want to use, because those are really more for your single family, small multi, maybe vacant land type search. CoStar, Reonomy, the bigger commercial guys are, the ones where, okay, I want to buy a 24 unit apartment complex and I want to find a seller who's going to sell me one of those from direct to seller, right? That's really where you want to target the more, commercial based ones. They can get pretty pricey. All of them can get pretty pricey. But yeah, I've used them all, and I still actually use them all. I hadn't used ListSource for like the last year because I've been using PropStream and Bello and another one, and I just pulled another one from ListSource just to switch it up every now and then. And then in terms of categories, it's going to depend on what you're trying to do. If you're trying to look for specifically larger multifamily property, I'm going to filter it based on okay, well, what type of owner is it? Is it an LLC? What's the location? How many units? How many bedrooms and bathrooms are going to be in it? What was the year built? Versus a single family, you might be like, okay, I want a vacant property, which obviously I'm not going to check vacant if I want a multifamily property because they don't categorize it like that. So yeah, tons of different opportunities to find deals through pulling lists and sending mail.
Yeah, 100%. Last kind of tactical question on this before maybe we switch gears here. So how do you filter the list? Obviously, you filter the physical criteria, 20 to 100 units in the geographical area, et cetera. Maybe you filter out people that own it with an LLC, or you do something there. But do you filter out properties that have recently sold? Do you filter by some equity? Do you filter based on some information like that, or do you just mail everybody? No,
yeah, great question. And I think this market that we just had is actually a good example of how maybe being able to pivot. So, the first couple of years, it was always, okay, that you've had to have owned it for 5 years, right? I don't want to send a letter if you haven't owned it for 5 years because you haven't had enough time to appreciate. However, somebody who bought a property in 2019 or 2021, which was 2.5 years ago, right? Their property has appreciated by freaking almost 40% if they, or call it 2020. So they have a good amount of equity in that. Not to mention, what if those guys bought it on hard money like I did on that one property, and now they can't refinance it, and they get a letter from me saying I want to buy the property, and they're running into a situation where, hey, I can't really refinance this. Maybe it is a good time to sell it. So I don't know. There's a little bit of a being able to pivot, testing different things out. But in general, I would say the longer somebody's owned something, the more equity that they've built up typically. And so having a years of ownership of 5 or 10 year minimum. has a much higher return than somebody who just bought a property last year or a couple months ago.
No,
So
100%.
hopefully that answers. Yeah.
No, we do something similar too. You know, we typically like nothing over the last 3 years, but there's an argument now to maybe mail to folks that have bought in 2021, right? Or
Exactly.
Late 2020 because of the fact that, you know, the market's gone insane since then, and they still probably have equity, right? They probably, a lot of those folks have equity and are still, you know, under some kind of bridge loan maybe, and maybe want to sell, and they may have, you know, done their value add. And I think it all, you know, the question you have to ask yourself is, how good of a deal do I want to get, like as an investor? Mm-hmm. And everybody has a different answer for that. You know, somebody that doesn't really care about paying, you know, close to the market, they just want to buy their deal a year and they just want to increase the likelihood that they can get in front of more sellers. Mail to everyone, you know, who cares, right? It's, you know, that's a different criteria than somebody who needs to buy everything at 80% of value, like day one. Correct. And they might have to filter their list a little bit more. Yep. So, you know, again, some other questions to help frame maybe how you apply that in your business for all the folks listening. But let's, so I'm going to kind of jump back to maybe earlier in this episode. You were talking about how you're into some development now. You guys are pursuing, I mean, larger deals. I know you guys are under, I say you guys, I don't know who else is involved in this, but I assume there's multiple folks involved in a very large multifamily deal. I think it's 600 plus units. Let's talk about maybe the development transition and maybe some of the learning, maybe not learning lessons, but some of the, you know, I guess why, and then what you've had to learn to look at deals through that lens and maybe to start actually getting into that world.
All right. So, to break this down as simple as possible, all these larger deals, I came across them years ago, right? Not the same deals, but I came across large deals, you know, 4 or 5 years ago when I was sending direct mail, but I honestly didn't know what to do with them, right? I mean, I just bought a property last year in Gardner that's 36 units that I came across in 2019 from a letter, and I passed up on the deal because I had no idea what the hell. I'm like, I can't pay this much money. I don't know what I'm doing with this. I could have bought the property for 600 grand less than I bought it for this past year. And it was listed on, it was brokered. And so, you know, I look back at that and I'm like, man, like the opportunities I've had that I've let go on deals that like that, just because I couldn't wrap my head around the numbers of it. And like, oh my, I don't know what I'm doing with 36 units. Right. I started to really, okay, well, like, why would I be afraid of a 36 unit, right? Like, why would I be afraid of a 400 unit or 1,000 unit building? It's just numbers. I'll figure out how to deal with everything else later. It just seems super overwhelming. And so, you know, as I started to come across these larger deals, I really started to look at them like, well, what happens if I actually dig into this and I can actually figure out how to take it down? And that has really been, you know, sort of a mindset shift, but that's how I've been able to get into these larger deals. I mean, I just entitled a bunch of duplexes, and I'm about to sell that for more money than I made last year in general on one deal, just because, and that was from direct mail. I've got another 36 unit development deal in Norton, Massachusetts. And, you know, that one came from direct mail, like direct mail who connected me with somebody, and I got the deal through that person. But again, direct mail led it. You know, and then the 680 unit one, a direct mail piece landed in an agent's hand, and he ended up calling me, and this deal got put together. And so I don't mean to keep hammering the direct mail, but it's, you know, opening the mindset to, why do I have to keep doing small multifamily? Why do I have to keep doing 8 unit and 10 unit buildings? Why not take down a huge property, right? It may be a little longer, maybe a little bit more challenging, but ultimately it's not that hard, right? It's not that hard. And so, yeah, that's really, that's how I've been able to bridge that gap.
Yep. Now on the development side, because I'm curious, is the model here, you know, let's buy some land, entitle it, then sell it off, or do you actually want to see developments through construction? And are you looking to build and sell, build and hold, or is the game plan like, hey, we're buying some land, or maybe, you know, a house that's on a big piece of land, there's a higher and better use for this land, and then you buy it with the assumption that you can, you know, maybe get it approved for something along those lines? Is that how you've made money on that side so far? Or do you actually plan to execute on some of those developments?
You know what? That's a great question. And you know, as I did the first one, I'm building another house right now. As I see them, you know, come through fruition here, I really do want to go through a full build. But, you know, to build 36 units, I mean, the build out's it's like $13 million, right? And so like, you got to bring 25% down. You know, we're talking like $3-4 million. And I have not done a deal that size before. So it's really risky for me to go out and raise all that capital to do a deal that I've never done like that before. And so my motto was, okay, on the first one, the first big deal, a bunch of duplexes I entitled, I'm going to sell that so I can get really capitalized, like really well capitalized, so I can go then do the next one and go through the whole build maybe not by myself, but feel comfortable doing it instead of being, again, bootstrapping my way through a deal. And I also learned a ton through that land development. And so moving forward, that the 36 unit build, we're going to go through the whole thing with that one. I have a land entitled here in the town I grew up in for 4 duplexes, so 8 units. I'm going to go through and build all those. And so yeah, it's absolutely to get the land, entitle it, and go through the whole process. But again, it's just like buying multis to hold forever. I can't hold them forever. I'm going to sell some of them because it makes more sense to either recoup the capital or invest it somewhere else. So yeah.
100%. No, that makes sense, right? I mean, it's just a different game. I think that's the big difference here is, yeah, I mean, maybe you entitle some and you sell some, you make a quick buck, and then maybe you see some all the way to the end product and then sell it, and maybe you hold some, and it's you can sell at different parts of that process and capture the value that you've created at different parts. But
correct. I think a lot of this has stemmed from, like I said, all I did was buy rentals and hold them for years, right? Like the first 4 years. And then I started to get a little bit of taste of like, okay, I'm going to flip this property. I'm going to wholesale this property. And dude, like I started to really make some serious money when I started doing that. And then I started looking at rentals and I'm like, why am I buying something and keeping the money tucked in there to make a couple $1,000s a month on it when I could, really amplify the velocity of that so much faster. And so that's really the idea with the developments. They take 18 to 24 months to happen. I get that. It takes a long time. But the chunks that you make on them are years and years worth of buy and hold properties that I can now take that capital and go buy a ton of buy and hold properties. And I don't have to raise money for every single one of them anymore. Right. And so that's really that's the concept behind it.
Yeah. And it's interesting. I've heard, I can't remember who said this. I didn't come up with it. So somebody else came up with this, and maybe I heard it on a podcast, but somebody, when they were talking about multifamily investing and comparing investing in multifamily properties to investing in single family properties, right? Buy and hold single family rentals. Mm-hmm. And he was like, single family they're like pigs. They're meant to get fat, and then you slaughter them, and then you whatever, you eat your bacon, right? But it's not long term. And he's like, and then multifamilies are like cows, right? You milk them along the way, and then you can sell them, and at the end of whatever, you slaughter the cow, right? His analogy. And I was thinking about that, and I was like, you could probably extrapolate the single family rental example to single family rentals and small multifamily properties, right? Maybe you define that as 2 to 4 units, or maybe you get a little bit bigger, 2 to 6 units, what have you. It doesn't really make that much sense if your goal is to build cash flow and have a high return on equity from a cash flow standpoint, to buy 2, 3, 4, 5 unit properties and hold them. Like, it doesn't make as much sense, right? It makes a lot more sense when you get to 20, 30, 40, 50, whatever units, because the debt's better, because you have, better economies of scale. Your expense ratio is a little bit lower. Expenses as a percentage of your collected income is lower, versus a duplex where, again, you haven't really entered. Yeah, technically it's multifamily in that you have multiple units under one roof, so to speak, but it's more similar to single family than it is to multifamily, right? Same thing with a 3 or 4 unit, because expense ratios are higher. Your return on equity is typically going to be lower because you can sell it to an owner occupant. So they're typically trading at a higher price per unit comparatively to what you can get in rent. And that's something that took me forever to learn myself too, was like, I should have been more transactional on the smaller stuff, even though, because I understood the single family piece of it just implicitly. I was like, I'm never going to buy and hold single family. That just doesn't work. And it doesn't work around here, financially speaking anyways, right? But that is another component of this that I think people should consider, right? Because yeah, sure, it's technically multifamily, but maybe you're just transactional with the smaller stuff and you hold the bigger stuff. And that's really what we've been doing in our business, is we sell a lot of the 5, 6, 7, 8 unit properties, and we try and hold the bigger ones, or the bigger portfolios that we can finance with better debt for a longer period of, and those are our, quote unquote, long-term holds.
Yeah, dude, that is awesome. I'm just going to use an example just to kind of wrap that point up. Larger properties were built to be a business, right? Like, no one builds a 40 unit apartment building to live in it themselves, right? Like, that doesn't happen. So they're literally built to generate income. Duplexes and triplexes, and even 4 families, even 5 families, when those things were built in the 1900s around here, they were built for people to live in them. They were, to go to work next to the property next to their business, essentially, right? Whether it was a printing press or a paper store, whatever it was. Those weren't used to generate capital. They were used to house a bunch of people. And so now what's happening is you've got people who, live in most of the duplexes. They're not rentals, right? They're home owners that are buying these duplexes. And so I'm going to use an example here. I bought a duplex for 275 grand. I spent 65 grand on a rehab. And then I looked at it and I'm like, okay, what do I do? Do I buy and hold this? And do I take the $800 a month in cash flow? Or do I sell it and make 130 grand? Like, how many years would it take me on 1,000 a month to make that 130 in 8 months? Or it's less, it was like 4 months, right? And so you can't say the same about larger multifamily though, right? Like larger multifamily, I may make a couple $100,000 if I sell it that fast, but the thing might be making me 10 grand a month. Like it makes more sense to keep, to keep that larger one and maybe again, stay transactional in the smaller ones and use the smaller ones to generate capital, right? Generate capital, live the lifestyle you want to, and dump the rest to invest in big deals. And so, yeah, I'm all on board for the smaller ones to be transactional.
Yeah. And it's all a process too, right? Because, there's a lot of, big dogs that are the level above us that are like, why would I ever hold something that's 50 units? Like that's stupid. And they're comparing, the 50 units to the pig in my analogy that I'm stealing from somebody else. Right. And they're like,
Absolutely.
we're only holding stuff that's 200 plus, so it's all just, you level up in the game and that changes how you think about these decisions. But it is objectively, the math says that your expenses as a percentage of your gross income are just lower the more units you have. And then there's a massive change when you go from 3 units to 10 units, right? Because many of the buyers, unless you're in a true war zone and nobody wants to physically live there and people are only buying it for investment purposes, but like you sell a duplex, most of your offers, and this is, I don't know the math, I'm assuming this, right? More than 50% of your offers are coming from owner occupants. If you're selling a 3 unit, a very large percentage of your offers are coming from owner occupants. They're not underwriting this, price per unit, net income. They're like, hey, a couple of units pitching in money towards the rent. Cool. So yeah, different game. But but now let's talk about this big deal that you're working on. And only if you're comfortable talking about this, because I know oftentimes a deal that's still in process, right? It can be, a little what have you, but we can leave details vague. We can, even change the numbers or what have you. Sure. But I think the reason I want to bring it up is because there's a misconception out there that like, all of this direct to seller stuff works up to a point, right? Up to 30, 40 units. No one who's got a bigger property is going to sell their property off market, yada, yada. There's all kinds of limiting beliefs around that out there. And to an extent, I do agree with it when you get to like institutional, like no one's going to sell a 150 unit class A property in Boston direct to seller from a mailer. Maybe, but very likely that transaction won't happen. But you guys sunk your teeth into something of some size here. Maybe talk about just some examples that disprove that belief. Maybe we can talk about this deal in a vague capacity or however you're comfortable chatting about it.
Yeah. So like I said before, the letter that got sent to an agent really, and it wasn't even for this property. And so I can't take credit for, hey, this direct mail letter made it to this property owner and they ended up, we ended up going on agreement on 680 units, right? I can't say that actually happened. However, what I can say is I have sent letters in the past. And when I look up who called me back, they are A-class 200 unit apartment building, brand new build in Fort Lauderdale, right? And so like I looked them up and I'm like, oh my God, they replied to a letter, right? And it ended up being an admin. It wasn't the actual owner. So that's what you're going to run into really, right? Like if you have this institutional owner and you're trying to send direct mail to, these A-class properties or massive properties, likely what's going to happen is, the secretary or an admin will reach out to you. It won't be the actual decision maker of that business. And so that's what I've run into quite often. So the moderate size works really well. But this specific deal, when it got sent to me, it was, hey, I got your letter. It was a while back. If you have any deals in Mass, let me know. Didn't think anything of it. Ended up following back up with me months later. I have 680 or 700 units in Western Mass. And I'm like, the hell am I? This is the mindset, right? I'm like, the hell am I going to do with 700 units? I can't take that down. So I said, all right, forget it. But I ended up mentioning it to a partner of mine, and he was like, dude, just send me the financials. Like, what? Like, let's just take a look at it. And so I sent it to him, and we went back and forth a little bit, and he's like, dude, offer like 15 million less than the asking price, just because we know it works at that number. Just offer 15 million less. So I did. They came back. They dropped the price $10 million. Then we ended up negotiating a little more, and we ended up getting around for 61.5 million. So we're just finishing the P&S right now. So I can't speak on much else other than the the idea is that we're assuming 2.99% debt over the next 3.5 years, amortized over 30 years through a really large, very well-known bank, and that the owners of this had a bunch of fires in some of the properties, and they are very mismanaged, and they're extending outside of their location where they typically manage properties. And so, we kind of stepped in and said, first of all, the debt, you can't beat it. Number two, all we do is inherit mismanaged properties and then fix them up. This is a massive project, sure, but it's not something that we probably can't handle. I mean, it may take us a little bit longer than maybe a giant corporation that's going to go in there and do it, but we'll figure it out, right? And so that's kind of where we're at right now. So I can't speak on too much more other than it's assuming debt, and it's a huge deal. So
no, I mean, that's enough, right? And I think the objective of me bringing that up was to illustrate the fact that, maybe you didn't hit this guy with a mailer and it's some mom and pop guy that's getting, dragged in the mud, and he's like, all right, let me fire sell my 600 plus unit portfolio. But, you planted this, kind of a breadcrumb that caused this agent to, make a call, and, one thing leads to another. It's like a domino, right?
That's all it is.
Get your name in front of someone, and then it's hard to think about how all this stuff spider webs out.
I say this
concept.
Man, I say this all the time, and a lot of people are like, well, you're spending all this money on direct mail and you don't even get that many deals from it. Well, first of all, you do get a lot of deals, but you got to do it at scale. But really, the purpose of this is the amount of networking that I have gotten from direct mail is unbelievable. I've met agents, attorneys, agents from other states, investors. The partner who I have over 100 units with, I met him through a freaking direct mail letter, a piece of paper, dude, that I paid $1 to send out, right? And so, like, you never know whose hand it's gonna land into and what the conversations will come up. And down the road, you're consistent with this, things end up coming to fruition. So
no, that's great, man. Last question, and then we'll start to wrap up here because I want to get you out of here on time. How has your underwriting criteria changed? How are you looking at? Maybe it has or hasn't, right? I'm assuming it has, but when you're looking at a multi-deal now comparatively to when you were looking at something last year, whatever, 10 to 50 units, kind of these small to mid-sized deals that have been your bread and butter. How are you looking at them differently? Are you looking for different types of deals? Looking for smaller projects, still looking at the same size projects? How are you thinking about the business right now? Mm-hmm. And this is, assuming we're in May, June 23.
Yeah. Really simple. I'm not refinancing anything. Like, there's no game plan to refinance property. And so, if I'm going to take down a property of size, I am not telling any investor or any partner or anything like that there is any type of refi in the next, 2, 3, 4, 5 years. I mean, how can I possibly say that to somebody when interest rates are 6.5 and they could be 8.5 or they could be 5? Like, I don't know. No one knows. And so from an underwriting standpoint, I still have to make sure it's 70% below what, where it should be in the market. And after the rehab, I still have enough cushion in there. So that aspect hasn't changed, but really it's let's go in there, let's refinance this thing, let's pull back all the money out, and you're going to get this huge, return on your money from the cash flow after you get a bunch of money back. I'm not doing that. And it's kind of been challenging to raise capital from that standpoint, because a lot of investors want to, they want to amplify their money, right? Throw it in there, do your thing, and then refinance it, kick it back to me, and we'll just keep it rolling. So I don't know I'm curious about what you're doing too, because we're doing similar things over there from that front. But yeah, man, I'm not really projecting any refinances. It's so.
No, I mean, it's a great way to approach it, right? And it's like, if the numbers work and you have your, you buy with some like local bank or credit union debt for 5 years, fixed for 5 or something like that, and it works, and you can, you have positive leverage from a fundamental standpoint, you can pay, and there's some roadmap to growing NOI, creating value, then it's kind of hard to lose. It's just a matter of aligning your investor expectations, as you mentioned, which can be challenging. We're facing the same challenges in our business, but in terms of what we're doing, it's very similar. We are buying with debt that isn't going to force us to refi. And if we're raising money for a deal, we're raising more than we probably should. And reason being that if we go over budget on our renos, if we, run into some challenges in terms of what the business plan takes longer to implement, we just want more money. So that's the other piece of it. We're just underwriting more reserves. And from that solves we're not going to be a forced seller issue. I think where people are probably getting stuck now, and this is where we've spent a lot of time thinking about what we're doing, is what do you do if like the market is like adjusting? Like how do you think about making an offer today if the market's going to be worse in a couple of years? And how do you make sure you're not overpaying like today, right? Regardless of servicing debt. And, for us, like we're very big on just like we underwrite like a return on cost, so if we're, we buy a property for $1 million and we put, I don't know, this is just, I'm going to outrageous example's sake. Let's just say we buy a property for 500, we put 500 into it. We're into it for $1 million. It's got an NOI of 100,000. Our return on cost, our yield on cost is 10%. And so long as that number is more than, a couple percent, 1.5%, 2% higher than what the current cap rate is in the market, it's going to be hard to lose. Like you create a lot of value if you just get those two numbers right. So if you're in an area where the cap rate's 7% and your underwriting says after we spend all of our money on CapEx and on the purchase price and, we have our new rents, if we're going to produce 9%, you're going to be, it's hard to, you have to fuck it up pretty badly along the way to lose on a deal like that. So that's how we think about it. We're just looking for a bigger spread there. And that's compensating 100%. Us for what the market's doing. Dude,
awesome. And I think to summarize this up is like, you're not finding these on the MLS. You're not finding these that are no. Like I just don't. I don't understand. I just don't get how people unless you're really good at trying to find value in something that's sitting there that everyone and their mom can see. I don't get it. I just don't understand it. Like it's direct to seller or literally don't buy something. In my opinion, I don't even look at things that are sent to me half the time because it's just not worth it. Right? I mean,
exactly. Yeah, I mean, we've probably made, I don't know, 30, 40 offers this year on deals that have a broker attached because we still like to offer, get some feedback. Sure. And you never know when someone's going to bring you something.
Yep.
And it's just like, we're not like, and I was talking to somebody about this the other day who was like complaining about not being able to find deals and they just, wait for brokers to send them stuff. And I was like, dude, you're not going to do any deals. Like you're just not. I don't know what you want. I don't know what you want to hear. Like, you can just bitch and moan about it, which is what everybody does. And I certainly bitch and moan about it myself. It's harder to find deals, but at least, we are still getting out there and we're under contract on a couple of bigger ones right now. Maybe by the time this airs, we'll be, raising for them, actively raising capital for them. But yeah, it's just like, it's challenging. And if it's challenging for the people that are making 500 cold calls a week and sending thousands of mailers. So you're just not even going to remotely compete if you're just waiting on the brokers.
Correct.
And, we're not even close with deals that have brokers attached. Talking like, hey, we're taking a deal out at $1.5 million and we're at like $1 million, like we're 30% plus off. Like we're trying to like stretch to get to those numbers. So we've certainly stopped putting as much time and energy into developing those broker relationships right now because we just haven't seen any movement in where folks are taking deals out. And if we start to see some more movement, if we start to see some deals where maybe we're 15, 20% off the asking price, we'll start to really try and dive back into that world. But I hear you. It's I have the same thoughts that you do where it's like, I don't know if you're in this business, why are you not doing this? Like, because, unless you truly don't have the time or money and like, you don't care and you're willing to, buy the 6 unit off the MLS once a year and you're okay paying market, you self-manage, you got a high income source from somewhere else. And this is truly a 20-year retirement plan for you. Great. Your goals are different.
That's fine.
Your strategy should be different. But if you're in this game, if you're in the deal game, you can't do that. So
yeah, well put.
Cool, man. All right, well, let's get you out of here. And obviously, before you go, where can folks reach out to you, learn more about you, hit you up, all that fun stuff?
Yeah, I've last time I was on here, I did no social media, so now I am very active on social media now. So Instagram, Facebook, either at Ryan Corcoran or Specialized Property Group, either one. Connect with me there.
Cool. And just real quick as a plug too for everybody, because we have a lot of folks in New England that listen to this. What's like we touched on this a little bit, but like, where are you looking to buy right now? I know you're Rhode Island, Mass, New Hampshire.
Yep.
I don't know if you want to add anything to that.
Yeah. So we bought a property in Georgia last year. I've got a couple lots that I'm going to be building in Florida. So, I mean, honestly, man, like New Hampshire, Mass, Rhode Island is the goal. So if you got anything in that area,
core, but you'll get outside of that too.
Correct. Yep.
Cool. Sounds good, man. Well, I appreciate the time. I mean, always great to chat. So thanks for coming on.
Yeah, man. Appreciate it. Thank you very much.
Thank you for listening to this episode on the Multifamily Wealth Podcast. If you learned something new during the show, please consider sharing this episode with a friend, family member, or business partner, or just leaving a rating and review as it helps the show get noticed by more folks. Catch you next week.